Welcome to session 14, Value-Based Management and Organizational Architecture. Here is a session outline, the corporate objective, what is value-based management, methods and key premises of value-based management, EVA approach, EVA in practice, Marathon approach, comprehensive value metrics framework, components of organizational architecture or performance management, executive compensation, organizational culture. What should be the objective of a corporation? On this very important issue, several positions have been taken. Maximizing shareholder wealth, stakeholder theory, enlightened wealth maximization, shared value approach, triple bottom line. Maximizing shareholder wealth has traditionally been the central objective in corporate finance. The underlying rationale for this objective is it allocates resources well in a society. Stakeholder theory argues that a company has multiple stakeholders and the objective of the corporation is to promote the diverse interest of various stakeholders in a just and fair manner. Enlightened wealth maximization, suggested by Michael Jensen, is a way of reconciling shareholder wealth principle and stakeholder theory. Shared value approach, proposed by Michael Porter and Kramer, argues that a company can contribute to societal problems as long as it derives economic benefit from solving those problems. Triple bottom line approach believes that there are three bottom lines: profit, planet, and people, and a company should simultaneously pursue these three bottom lines. In a related vein, ESG has been suggested. ESG stands for environment, society, and governance. Let us examine these objectives or approaches in some detail. Shareholder value theory was endorsed very powerfully by Milton Friedman, an eminent American economist. Some consider him to be the most influential economist of 20th century. He wrote a very powerful book called Capitalism and Freedom, in which he said few trends could so thoroughly undermine the very foundation of a free society as the acceptance by corporate officials of a social responsibility other than to make as much money for their stockholders as possible. Of course, he goes on to add that a firm should be run ethically and a firm should adhere to all laws of the land. There are three principal justifications for shareholder wealth maximization: legal, economic, and decisional. The legal argument is fairly straightforward. A company comes into being because of the risk taken by shareholders. Shareholders appoint the board of directors, which in turn appoints the management. So the board and management have a responsibility to promote the interest of shareholders. The economic argument for shareholder wealth maximization is akin to the invisible hand argument of Adam Smith. According to this argument, when a firm maximizes the economic value for shareholders, there is efficient allocation of resources in the economy. The decisional argument says that if a firm has a single objective, it is run very efficiently. But if a firm is saddled with multiple objectives, management may be conflicted in many ways. From a decisional point of view, it is far more efficient to pursue a single objective, subject to various constraints, of course. So there is a powerful logic to shareholder wealth maximization emanating from three areas: legal, economic, and decisional. Well, there is a compelling logic for shareholder wealth maximization. Four conditions need to be satisfied to justify shareholder wealth maximization: no externalities, no monopolies, complete contracts, and efficient markets. Let us look at each of them no externalities. A company can have a negative externality if it pollutes the environment and does not compensate people who are affected by pollution. On the other hand, a company can have positive externality if it creates infrastructure which is utilized by the neighboring community and the community is not asked to pay for it. No monopolies. A company which does not have any monopoly power is not likely to hurt the interest of vendors, employees, and customers and promote the interest of shareholders. On the other hand, if a company enjoys monopolistic powers, it can hurt the interest of other stakeholders in its search for enhancing the value for shareholders. Complete contracts. A company enters into contractual relationship with all stakeholders other than shareholders. As far as shareholders are concerned, they are entitled to residual income, whereas other stakeholders are entitled to certain compensation or benefits according to contractual relationship. If complete contracts can be written with other stakeholders, then the interest of those stakeholders would be protected by those contracts, and the company is then justified in pursuing the goal of shareholder wealth maximization. On the other hand, if complete contracts cannot be written, the company is likely to hurt their interest in its search for shareholder wealth maximization. Efficient markets. An efficient market is one where the prevailing price is a good proxy for intrinsic value. In practice, shareholder wealth maximization translates to maximization of the current stock price. If the current stock price is not a good proxy for intrinsic value, maximization of current stock price need not have the kind of social benefits that are envisaged under the argument of Adam Smith. According to the stakeholder theory, a firm has a number of stakeholders such as customers, employees, vendors, lenders, tax authorities, community, environment, and shareholders, and the firm should balance the divergent claims of various stakeholders. A similar point of view has been expressed by the Companies Act 2013, which says directors should act in the best interest of the company, its employees, shareholders, the community, and for the protection of the environment. In 2019, Business Roundtable, the most powerful group of American CEOs, spelled out the corporate purpose in this manner. Corporate purpose is to deliver value to customers, invest in employees, deal fairly with suppliers, look after communities in which they work, sustain the environment, and deliver long-term value for shareholders. The health of free enterprise capitalism depends on business delivering profits with purpose. Shareholder wealth approach and stakeholder approach have been the two dominant approaches to corporate governance. Shareholder wealth approach argues that a firm should focus on maximizing the wealth of shareholders. Stakeholder theory believes that a firm should reconcile the divergent claims of various stakeholders. According to Michael Jensen, these two broad strands can be reconciled in the enlightened value maximization principle. According to this principle, a firm should seek to maximize the value of equity in the long run while protecting and nurturing the interest of other stakeholders. One can argue that there is a symbiotic relationship between shareholder value and stakeholder interest. No company can create long-term economic value for its shareholders while hurting the interest of other stakeholders. To create long-term value for shareholders, a company requires sustainable and viable relationship with all stakeholders. Likewise, no company can sustain and maintain relationship with stakeholders unless it creates value for shareholders. If a company does not earn a rate of return which is commensurate with the cost of capital, sooner or later it will go out of business. In the process, it will hurt the interest of other stakeholders. We can view the relationship between a company and its shareholders and other stakeholders in a slightly different manner. Shareholder value can be maximized only by optimizing the value to other stakeholders. Optimizing involves providing a fair value. This means the company should provide value for money to its customers. The company should offer a very fair employment contract to its employees. The company must have a mutually viable relationship with its vendors, so on and so forth. Since shareholders have a residual claim in the company, it is reasonable that their value is maximized while other stakeholders' values are optimized. Advocates of corporate social responsibility argue that companies with their vast resources and capabilities ought to contribute to societal problems. This may be the reason why Government of India has made it mandatory for corporates to spend 2% of their profit after tax on CSR projects. However, if companies participate indiscriminately in CSR projects, they may suffer competitive disadvantage. Is there a way out? Yes, if companies are judicious in identifying societal problems that they are best equipped to address and from which they derive greatest economic benefit. When companies address social issues by creating shared values, self-sustaining solutions emerge that do not depend on subsidies. Porter and Kramer say when a well-run business applies its vast resources, expertise, and management talent to solve problems that it understands and in which it has an economic stake, it can have a greater impact on social good than any other institution or philanthropic organization. ITC's social forestry project is a great example of creating shared value. ITC invested in R&D, developed high-yielding varieties of eucalyptus and casuarina plants, distributed seedlings and other inputs freely, and devised attractive buyback schemes for farmers. By the end of 2010, 115,000 hectares had been brought under the scheme. It provided 99.4% of the wood requirements of ITC. It generated considerable employment equal to 500 million person days, particularly for tribal and marginal farmers, and the company turned carbon positive. Hindustan Unilever Limited created a direct home-to-home distribution project called Project Shakti for benefiting underprivileged female entrepreneurs. As part of its creating shared value strategy, Nestle has extended its relationships with farmers across emerging markets. All in all, it collaborates with more than 680,000 smallhold farmers, mainly in the areas of milk, cocoa, and coffee. It is fundamental that a company such as Nestle plays a positive role in society. Indeed, we believe that we will create long-term value for our shareholders only if we connect positively with society at large. This is what we call creating shared value. Porter and Kramer believe that the way forward is creation of shared value. Globally, the image of business has been dented in recent years. An impression that business is the major cause of societal, environmental, and economic problems is widespread. The solution lies in the principle of shared value. This implies creating economic value in a way that also creates value for society. As they say, shared value is not social responsibility, philanthropy, or even sustainability, but a new way to achieve economic success. It is not on the margin of what companies do, but at their center. We believe this will give rise to a major transformation in business thinking. Peter Drucker, an eminent management guru, has defined the purpose of corporation broadly. In his words, an important task for top management in the next society's corporation will be to balance the three dimensions of the corporation as an economic organization, as a human organization, and as an increasingly important social organization. In a similar vein, John Elkington has proposed the triple bottom line approach, wherein performance is measured in terms of three criteria, namely economic, ecological, and social. triple bottom line approach is also known as people, planet, and profit approach. A company must treat people fairly. A company must protect the environment. A company must generate profit and economic value. A somewhat related approach is the ESG approach, where the emphasis is on environment, society, and governance. In fact, many institutional investors look at their investing companies in terms of ESG criteria very seriously. It is heartening to know that many leading companies have committed themselves to more ambitious environmental targets than what Paris Accord calls for. Amazon has been the first signatory which has pledged itself to become carbon neutral by 2040. Microsoft wants to become carbon neutral by 2030 and on a cumulative basis carbon neutral by 2050. Unilever has a very ambitious plan which it calls the Unilever Sustainable Living Plan. ITC is carbon positive, water positive, social waste recycling positive thanks to its social forestry project. Top 3 asset management companies are increasing their shareholder engagement on environmental and social issues. Major challenges faced by the world are environmental degradation, social and economic inequalities. Politicians tend to be myopic, enlightened corporates tend to be far-sighted, governments are resource constrained, corporates are resource rich and well suited to contribute significantly to planet, people and profit. For our purpose, the primary objective of a business is to create long-term economic value in a legal, ethical, socially responsible, and environmentally friendly manner. I have emphasized this earlier and it bears re-emphasis. It is instructive to look at the statement of objective issued by several leading companies. Infosys, corporate governance is about maximizing shareholder value legally, ethically, and on a sustainable basis while ensuring fairness to every stakeholder, the company's customers, employees, investors, vendor partners, the government of the land, and the community. Reliance Industries Limited in its 2013 annual report said, at Reliance, we have been and continue to remain focused on creating long-term shareholder value. We are among the top 100 companies in the world and have been felicitated consistently for shareholder value creation over the past 3 decades. Reliance's performance can be attributed to a strong and integrated business model. On becoming the chairman of Tata Sons, N. Chandrasekaran listed his strategic priorities. He said his focus will be to bring the group closer to leverage its collective strength, reinforce a leader's mindset among the operating managers across the group, bring greater rigor to capital allocation policies, and deliver superior returns to its shareholders. If you look at some of the most admired companies in the US, such as Microsoft, Apple, Google, Intel, and Berkshire, and most admired companies in India, such as TCS, HUL, Infosys, M&M, HDFC, we find that these companies have created considerable value for shareholders in the long run while protecting and nurturing the interest of other stakeholders. This reinforces the point that I made earlier that there is a symbiotic relationship between long-term value creation and protection of the interest of other stakeholders. These companies have assiduously protected the interest of every stakeholder and created long-term economic value, and the symbiotic relationship between stakeholders and shareholders flourishes. There is a rising interest in value-based management. This is manifested in the following. 1. Large companies have accorded value creation a central role in their objective structure. 2. Traditional indicators like earnings per share are regarded as less reliable indicators for indicating future returns. 3. Increasing attention is being paid to link top management compensation to shareholder returns. For greater attention is given to shareholder rate of return in performance ratings by Business Week, Fortune, and Economic Times. 5. Various approaches have been developed for implementing value-based management. What is value-based management? Value-based management represents a synthesis of various disciplines. From finance, it adopts the goal of shareholder value maximization and the DCF model. From business strategy, it draws on the notion that value creation stems from exploiting opportunities based on the firm's comparative advantage. From accounting, it borrows the structure of financial statements with some modification. From organizational behavior, it uses the principle that you get what you measure and reward. Value-based management has become a huge consultancy practice. Many consultants have come up with their proprietary models focused on creating shareholder value. The prominent ones are Maracon Associates, Value-Based Management, Stern and Stewart, Economic Value Added, McKinsey, Economic Profit Model, Holt Value Associates, Cash Flow Return on Investment Approach, Eliki Alkar, Shareholder Value Analysis, PwC, Value Builder, KPMG, Economic Value Management. The key premises of value-based management are: 1. For managing shareholder value, firms should use metrics which are linked to value creation and employ them consistently in all facets of financial management. 2. A well-designed performance measurement and incentive compensation system is essential to motivate employees to focus attention on creating shareholder value. Among various approaches to value-based management, the EVA approach has gained greater popularity in practice. So the thrust of our discussion will be on the EVA approach, and the discussion is organized along these lines. For those who are interested in learning about other approaches, they may consult my book Strategic Financial Management and other references given at the end of this session. The two most important metrics in the EVA approach to value creation are market value added and economic value added. Market value added is defined as market value of equity and debt minus book value of equity and debt. Economic value added is defined as net operating profit after tax minus weighted average cost of capital multiplied by invested capital. To understand the different ways of calculating EVA, we will work with a specimen balance sheet and profit and loss statement. In the balance sheet, equity is 100 million, debt is 100 million, total of equity and liabilities is 200 million, fixed assets are 150 million, net current assets are 50 million, total assets are 200 million, revenues are 210 million, operating costs are 170 million, profit before interest and tax is 40 million, interest is 10 million, profit before tax is 30 million, tax is 30% of profit before tax, it works out to 9 million, profit after tax is 21 million. The firm has an outstanding debt of 100 million on which the interest cost is 10%, so the interest burden is 10 million. NOPAT, net operating profit after tax, as we have learned, is profit before interest and tax multiplied by 1 minus tax rate. PBIT is 40 million and tax rate is 30%, so NOPAT works out to 28 million. NOPAT can be calculated in a different manner. It can be calculated as profit after tax plus interest multiplied by 1 minus tax. Profit after tax in this case is 21 million, interest is 10 million, so interest multiplied by 1 minus 0.3 is 7 million. When we add 21 to 7, we get 28 million. Remember, NOPAT can be calculated in this manner or NOPAT can be calculated in this manner. Return on invested capital, as we have learned, is NOPAT divided by invested capital. Invested capital is 200 million, NOPAT is 28 million, so ROIC is 14%. The weighted average cost of capital is shown here. Cost of equity is assumed to be 15%, cost of debt in post-tax terms is 7%. Pre-tax cost of debt is 10%. Post-tax cost of debt is 7%. The firm uses equity and debt in equal proportion. So the weighted average cost of capital of the firm is 11%. Economic value added is the surplus left after making a charge for the capital employed in the business. EVA is also referred to as residual income or economic profit. There are different ways of calculating EVA. EVA is defined as NOPAT minus weighted average cost of capital multiplied by invested capital. In our example, NOPAT is 28 million. Weighted average cost of capital is 11%, invested capital is 200 million, so EVA works out to 6 million. A second way of calculating EVA is shown here. EVA is equal to invested capital multiplied by the spread between return on invested capital and weighted average cost of capital. In our example, return on invested capital is 14%, weighted average cost of capital is 11%, and invested capital is 200 million. So EVA works out to 6 million. EVA is defined in this manner as well: profit after tax plus interest multiplied by 1 minus tax rate. This sum is equal to NOPAT minus weighted average cost of capital multiplied by invested capital. PAT is 21 million, interest is 10 million, tax rate is 30%. So we get NOPAT as a sum of these two, which is 28 million, minus the product of weighted average cost of capital and invested capital, which is 22 million. EVA is 6 million. Finally, a very simple calculation is shown here. EVA is equal to profit after tax minus cost of equity multiplied by equity. Profit after tax is 21 million, cost of equity is 15%, equity employed is 100 million, so EVA works out to 6 million. The fourth calculation is intuitively very easy to understand, but it is not widely used by professionals. Here we know that when profit after tax is calculated, cost of equity is not taken into account. So from PAT we deduct a charge for cost of equity to arrive at EVA. We find that EVA is 6 million, and there are 4 different ways of calculating EVA. Here is one more example. This is drawn from the book Finance Sense. The balance sheet and profit loss account of a firm are shown here. The total balance sheet is 200 million, equity 100 million, debt 100 million, fixed assets 140 million, net current assets 60 million, net sales 300 million, cost of goods sold 258 million, profit before interest and taxes 42 million, interest 12 million, profit before tax 30 million, tax 9 million, the tax rate is 30%, profit after tax 21 million. The cost of equity is 18%, the cost of debt in pre-tax terms is 12%, in post-tax terms it is 8.4%, 12 multiplied by 1 minus 0.3. Since equity and debt are employed in equal proportions, the weighted average cost of capital here is simply the arithmetic average of these two numbers. NOPAT or net operating profit after tax is profit before interest and taxes multiplied by 1 minus tax rate. 42 multiplied by 1 minus 0.3 is 29.4 million. Invested capital is 200 million. Return on invested capital is 29.4 divided by 200, so it is 14.7%. The 4 ways of computing EVA are shown here. EVA is equal to NOPAT minus weighted average cost of capital times invested capital is equal to 29.4 minus 0.3132 times 200. EVA is 3 million. The second way of calculating EVA is invested capital multiplied by the spread between ROIC and WACC. 200 million multiplied by the difference between 14.7% and 13.2%. This also works out to 3 million. Third calculation, EVA is equal to profit after tax plus interest into 1 minus T minus weighted average cost of capital times invested capital. Profit after tax is 21 million, interest is 12 million, 1 minus tax is 0.7 minus 0.132 times 200. This also works out to 3 million. Finally, EVA is profit after tax minus imputed charge on equity, which is cost of equity times equity. 21 million, cost of equity is 18%, equity is 100, so EVA works out to 3 million. You'll find these 4 ways of calculating EVA being used in practice. Two important properties of MVA. One, MVA increases when the firm undertakes positive NPV strategies and projects. Two, maximizing MVA is consistent with maximizing shareholder value. The 3 basic drivers of value creation are profitability of the firm measured by return on invested capital, the weighted average cost of capital, and the growth rate of the firm. This is a very important equation showing how MVA is related to the basic drivers. MVA is equal to ROIC minus weighted average cost of capital multiplied by invested capital, the whole divided by weighted average cost of capital minus constant growth rate. We can dive deeper into the determinants of MVA. A chart like this is very helpful in this respect. MVA is a function of growth rate, invested capital, and return spread. Return spread is the difference between post-tax ROIC and weighted average cost of capital. Post-tax ROIC and weighted average cost of capital are the 2 basic determinants. Post-tax ROIC in turn depends on pre-tax ROIC and tax effect, and pre-tax ROIC depends on operating margin and capital turnover. Weighted average cost of capital depends on the post-tax cost of debt, post-tax cost of equity, and the proportions in which debt and equity are employed in the capital structure. Invested capital consists of net fixed assets and net current assets. Growth rate is influenced by business environment, market structure, and competitive strength. So an analysis of this kind helps us understand the key determinants of MVA. What is the relationship between EVA and MVA? EVA is the residual income for 1 year. It is a flow measure. MVA is the present value of all future EVAs. It is a stock measure. MVA can be expressed as the present value of all future EVAs. If we believe that EVA is likely to grow at a constant rate in future, we can make that assumption in this equation. Assuming that EVA grows at a constant rate of G%, the equation for MVA would be EVA1 discounted for 1 year, EVA2, which is nothing but EVA1 multiplied by 1 plus G discounted for 2 years, so on and so forth. This expression may look a little daunting, but it simplifies itself to a very beautiful equation, EVA1 divided by WACC minus G. This equation is identical in nature to the constant growth dividend discount model that we have learned in an earlier session. There we learned that if the dividend stream grows at a constant rate of G%, then the value of the share is equal to dividend a year from now divided by R minus G, where R is the required rate of return by equity shareholders and G is a constant growth applicable to dividend. We have a similar equation here. EVA for year 1 would be this return spread multiplied by invested capital. So this is the equation for MVA. We can examine the sensitivity of MVA to variations in return on invested capital and growth rate given a certain invested capital and weighted average cost of capital. Let us assume that invested capital is 1000 and weighted average cost of capital is 12%. This table shows how sensitive MVA is to variations in ROIC and growth rate. If ROIC is 12%, irrespective of what the growth rate is, MVA does not change at all, because as long as ROIC and weighted average cost of capital are the same, MVA is not responsive to variations in growth rate. If ROIC is more than weighted average cost of capital, MVA increases as the growth rate increases. You can see when ROIC is 16%, MVA is 444 when the growth rate is 3% and 1333 when the growth rate is 9%. On the other hand, if ROIC is less than weighted average cost of capital, higher the growth rate, more negative the MVA. This is a useful table to understand the impact of variations in ROIC and growth rate for a given level of invested capital and weighted average cost of capital. For measuring NOPAT and investment capital, adjustments had to be made for the distortions of generally accepted accounting principles. The gap between GAAP-based accounting information and economic reality stems from the extreme conservatism characterizing accounting practice. To calculate EVA, that is a reliable guide to value creation, several adjustments are required to accounting earnings and accounting book value. The purpose of these adjustments is to derive a NOPAT figure that reflects economic performance and a capital figure that measures the capital contributed by shareholders and lenders. Stern and Stewart have identified more than 160 potential adjustments. These relate to things like intangible assets, strategic investments, market promotion outlays, goodwill, timing of expense and revenue recognition, off-balance sheet financing, passive investments in marketable securities, restructuring charges, bad debt recognition, inventory valuation, foreign currency translation, depreciation, taxes, and non-interest bearing liabilities. In most real life situations, however, 5 to 10 adjustments suffice. The more important ones tend to relate to the following. The important adjustments for correcting the distortions of GAAP while measuring NOPAT and invested capital are as follows. 1. Capitalize R&D investments and write them off over a period of time. 2. Capitalize goodwill and check for impairment periodically. 3. Hold back the outlays on strategic investment in a special suspense account. 4. Don't flow restructuring charges through the income statement. Instead, add restructuring investments to the balance sheet. 5. Replace straight line depreciation with sinking fund depreciation if necessary. 6. Exclude passive investments and income thereof. I am not discussing these adjustments because they are of relevance to finance professionals. For those who are interested, they may consult my book on strategic financial management, where I have discussed these adjustments in greater detail. I want to emphasize that this course focuses on key ideas, intuitions, principles, and techniques without getting into excessive technicalities which are of relevance only to finance professionals. In traditional financial management, different measures are used for different facets of financial management. Firm goals are defined in terms of revenues, profits, and EPS. Business plans are cast in terms of revenues, profits, and EPS. Divisional performance is measured in terms of divisional profits or return on investment. Capital budgeting is done in terms of DCF analysis. Performance targets are based on negotiated profit targets. Incentive compensation is usually small and range bound. Financial structure remains static. In EVA-based financial management, EVA is used for all facets of financial management. Firm goals are defined in terms of EVA. Business plans are prepared in terms of EVA. Division performance is measured in terms of EVA. Capital budgeting is done in terms of EVA. Performance targets are formula linked EVA targets. Incentive compensation can be unlimited and is EVA linked, and capital structure is treated as a very dynamic thing. So the basic difference between EVA based financial management and traditional financial management is that in EVA based financial management, EVA is used for all facets of financial management. In traditional financial management, different measures are used for different facets of financial management. EVA and incentive compensation. The centerpiece of the EVA financial management system is a unique bonus plan that aligns the interest of managers with the interest of shareholders. The key elements of the EVA bonus plan are: bonus is linked to increases in EVA. There is no floor or ceiling on the bonus. The target bonus is generous. Performance targets are set by formula, not negotiation. A bonus bank is established. The whole idea is to convert managers into owners, to make managers feel the pain as well as experience the gain of owners. It is instructive to look at how bonus behaves under the traditional bonus plan and under the EVA bonus plan. In the traditional bonus plan, bonus is payable only when a certain level of performance is reached. Here, the level of performance 80% of target performance, and thereafter bonus rises linearly with actual performance. However, beyond a certain level of performance, there is no further increment in bonus. Essentially, bonus is capped. So bonus behaves in this manner. There is no bonus up to 80%. At 80%, the bonus is equal to the height of this line. Thereafter, it rises linearly up to 120% of target performance. Beyond that, the bonus is capped at this level. In the EVA bonus plan, a generous bonus is defined for a target EVA. However, actual bonus is linearly linked to actual EVA. If EVA rises, bonus rises. If EVA falls, bonus falls. There is no ceiling, there is no floor. Managers experience the gain and pain of owners just the way there is no ceiling on profit and there is no floor on loss. There is no ceiling on bonus. There is no floor on bonus. There are two noteworthy features of EVA linked incentive compensation. One, bonus is based on a predetermined formula. Two, a system of bonus bank is used. Let us understand the two features. Here is an illustrative formula. Bonus is equal to A1 times change in EVA plus A2 times actual EVA. If the actual EVA is negative, A2 is equal to 0. Here A1 is significantly higher than A2. The whole idea is to provide great incentive for improving EVA. The second feature is the bonus bank system. To understand the bonus bank system, let us look at a numerical example. In a normal year, the bonus earned as per this formula is 50. In a good year, the bonus earned as per this formula is 200. In a bad year, the bonus lost according to this formula is minus 100. The payout, of course, is moderated because of the introduction of the bonus bank system. Let us say the bonus bank has an initial balance of 100. The cumulative balance at the end of the normal year would be 150. The payout ratio is 1 by 3. So the bonus paid is 50. If from a cumulative balance of 150, if 50 of bonus is paid, there is a balance of 100 which is carried forward. In a good year, when the beginning bonus balance is 100, and 200 bonuses earned, the cumulative balance becomes 300. The payout ratio is 1/3. Bonus paid is 100. Bonus carried forward is 200. When there is a bad year which begins with a beginning balance of 200 and the bonus earned during the bad year is minus 100, the cumulative balance is 100. The payout is 1/3. So bonus paid is 33 1/3 and the bonus that is carried forward is 66 2/3. From the cumulative balance, this much is paid, so this is carried forward. The idea of a bonus bank system is to moderate the swings in bonus payment and elongate the time horizon of managers. To sum up, the EVA-based incentive compensation system has 4 features. 1. Bonus is linked to EVA. 2. Bonus is based on a formula. 3. There is no cap or floor. 4. A bonus bank system is used primarily to elongate the time horizon of managers and moderate the swings in bonus payments. The steps involved in implementing the EVA system are as follows. 1. Develop top management commitment. There must be a senior manager who champions the EVA cause. He must be either the CEO or the CFO. 2. Customize the definitions of EVA. For calculating EVA, certain adjustments are required, and these adjustments will depend on the characteristics of the organization. 3. Identify EVA centers. An EVA center is a responsibilities accounting center. 4. Analyze the drivers of EVA. 5. Tailor an incentive compensation system. 6. Train all the employees. EVA is meant to ensure that employees understand the financial aspects of the business, so financial literacy of employees is essential. There are problems in using EVA. 1. It can lead to a disincentive or collaborative relationship. 2. It is an imperfect measure. 3. It may cause underinvestment in strategic projects where there is no payoff for a couple of years. 4. There is difficulty in divisional performance measurement. Perhaps the earliest adopter of EVA-based bonus system was General Motors. For 60 years, General Motors used value sharing in economic profit. 10% of GM's profit above a 7% return on capital was the formula for the bonus pool for many years as the basis for all incentive compensation. General Motors' history highlights ways to improve public company incentives and corporate governance. By the way, economic profit is almost identical to EVA or residual income. It must be emphasized that General Motors had the best performance management system for several decades, and it was the largest and the most profitable organization in the world for several decades. Perhaps this discipline was lost in 1980s, and General Motors has been facing a lot of problems since then. EVA has been successfully implemented in many organizations. Coca-Cola is a conspicuous example. Robert Goisita introduced EVA formally in Coca-Cola in 1987. He did 3 things. 1. Concentrated capital in the hugely profitable soft drink business and dumped a motley of low ROI businesses. 2. Coax managers to do more with less capital. As a result, they produced in 40 plants what was earlier produced in 52 plants. They replaced expensive metal containers in which concentrate was supplied with inexpensive plastic ones. 3. Used more debt. As a result, weighted average cost of capital was lowered from 16% to 12%. Thanks to these measures, Coca-Cola achieved dramatic improvements in performance. EVA soared and the stock price rose from $3 to $43 during 12 years of his leadership. This is cited as one of the most successful implementations of EVA. EVA has gained wide acceptance in Indian companies. In an Economic Times survey, 3/4 of CFOs reported using EVA for some purpose such as capital budgeting or as a performance measure for external reporting or internal comparison between strategic business units and product lines. EVA-based performance management has been introduced in Godrej Group. 6 companies of Godrej Group have been covered. Major goals have been to improve capital efficiency and overall performance, encourage owner-like behavior, and reduce gaming. The key elements have been EVA improvement targets, EVA-based incentive plan as per the classic Stern Stewart architecture. Key challenge was to obtain buy-in from principal managers. The experience was that significant improvements were noticed in overall business performance, capital efficiency, and market share, and it discouraged managerial practices such as hockey stick forecast, trade loading, and inefficient use of capital. In hindsight, they realized that they were too aggressive in setting stretch targets, so they have been fine-tuning their bonus architecture in order to further improve the efficiency of EVA. Mahindra and Mahindra too has been an early adopter of EVA on the Indian scene. At Mahindra and Mahindra, the initiative was taken by the Treasury Department, which educated technical people on return on capital employed and EVA, as Arun Nanda, its executive director, said in 1998. We needed to educate non-financial people on the financial implication of businesses. Previously, say about 20 years ago, the person who found that a machine tool was not working would say, let's change it. Now, you see engineers sitting down and doing EVA calculations to see that it is going to work out. He added, in our system, what we have done is when you draw capital from the central treasury, you are debited for the cost of capital, but importantly, you don't get capital till you show a minimum benchmark return on capital. We take the replacement cost of the asset. Hindustan Lever, now Hindustan Unilever, switched to EVA in the mid-1990s. As V.K. Vishwanathan, its then financial controller, put it, that involved a big change. When it was introduced, it was not introduced by the accountants but by the businesses themselves. We felt that the best way to implement the system was to get the businesses to buy into it. Therefore, with it came both focus and acceptability. There are other non-financial measures, but among the financial measures, this is the most important single performance measure that we use. We consider this to be the most important yardstick.
Given its emphasis on EVA, Hindustan Unilever provides information on EVA in its annual report, which is a rare practice. Here is an extract from its latest annual report. EVA is calculated as net operating profit after taxes minus cost of capital employed. NOPAT is defined as profit after depreciation and taxes, but before interest costs. Cost of capital employed is weighted average cost of capital multiplied by average capital employed. Cost of debt is taken at the effective rate of interest applicable to a AAA rated company like Hindustan Unilever for a short-term debt net of taxes. They have considered a pre-tax rate of 6.43% for 2021-22 and 6.28% for 2020-21. Cost of equity is calculated using the capital asset pricing model, which is risk-free rate plus beta multiplied by market risk premium. Risk-free rate is equivalent to yield on long-term government bonds and is taken at 6.84% for 2021-22. Market risk premium is taken at 3.68%. Beta variant for the company is taken at 0.614. So HUL's cost of equity when calculated comes to 9.09%. The EVA calculation is shown for a 5-year period. Please note that the opening balance in the year 2020-21 has been adjusted for the GlaxoSmithKline merger. For the year 2021-22, average debt is 0. Average equity is 47,156. All the figures are in crores. Average capital employed is 47,156. Cost of debt post-tax is 4.81%. Cost of equity is 9.09%. Weighted average cost of capital is 9.09%. So cost of capital employed is 4,289. Profit after tax before exceptional items is 8,724. Net operating profits after taxes, no PAT, is 8,724. Cost of capital employed is 4,289. So EVA is 4,435.
EVA in China, the Central State-Owned Asset Supervision and Administration Commission of the State Council of the People's Republic of China, or the Central SASAC, a massive holding company that governs a portfolio of 100 companies with $3 trillion in assets, $3 trillion in sales, and 12 million employees, initiated at the beginning of 2010 a 3-year performance assessment policy which affects the performance evaluation compensation of the senior management, CEOs, CFOs, and vice presidents of all state-owned enterprises. This policy seeks to promote greater efficiency in capital management. Starting in 2010, performance assessment would be based on sales growth and EVA, sales growth being assigned a weightage of 60% and EVA being assigned a weightage of 40%. Here is a useful matrix to guide senior managers and corporate directors in resource allocation strategy. In this matrix, there are two dimensions: return spread, which is defined as this difference between return on invested capital and weighted average cost of capital; growth spread, which is defined as the difference between growth rate in sales and sustainable growth rate. Remember, sustainable growth rate is a concept that we learned earlier. It is defined as the product of retention ratio and return on equity. If ROIC is greater than weighted average cost of capital, the company is EVA positive. If ROIC is less than weighted average cost of capital, the company is EVA negative. An EVA positive company creates value, an EVA negative company destroys value. If the growth rate in sales is greater than the sustainable growth rate, the company is a cash deficit company. If the growth rate in sales is less than sustainable growth rate, the company is a cash surplus company. In this quadrant where return spread is positive and the company has cash deficit, the recommended actions are cut dividends, raise funds, reduce the gap between growth rate in sales and sustainable growth rate. In this quadrant where EVA is positive and the company is cash surplus, the recommended strategies are grow faster by way of organic growth or mergers and acquisitions, distribute cash surplus by way of dividends and buybacks. In this quadrant where the company has cash surplus and has negative EVA, the recommended strategies are distribute part of cash surplus and use the rest to improve profitability, review and modify capital structure if necessary. If the above fails, sell the business. In this quadrant where the company is cash deficit and has negative EVA, the recommended strategy is to attempt drastic restructuring or simply exit the business. The previous graph underscores a very important point. Good management can be many things: great leadership, technological prowess, mastery of manufacturing, superior marketing. Good financial management is just one thing: good capital management, or the art of deploying scarce capital skillfully. And the graph shows what needs to be done under various circumstances. The basic recipe for value creation is very simple. ROIC should be greater than weighted average cost of capital. To create value, companies must do three things. They must beat their cost of capital. They must beat their cost of capital for many years. They must reinvest additional profits at high rates for growth. Firms look for growth opportunities all the time. Here are certain strategies for growth: market penetration, geographical expansion, new product introduction, vertical integration, diversification, strategic alliance, mergers and acquisitions, disruptive innovation, and turnaround. As Harsh Mariwala, founder of Marico, a company which has created enormous value for shareholders, said, I would like Marico business to have growth which builds shareholder value perpetually. Good growth increases not only revenues but improves profit, is sustainable over time, and does not use unacceptable levels of capital. It is also based on differentiated products and services that fill new or unmet needs, creating value for customers. Here are the summary guidelines for value creation in the realms of investment, financing, and distribution. Investment stroke divestment. Make an organic investment if return on invested capital is greater than weighted average cost of capital. Do an acquisition if the value received is greater than price paid. Do a divestment if the price received is greater than value surrendered. As far as capital structure is concerned, lower weighted average cost of capital while preserving flexibility. As far as payout is concerned, maintain dividend payout at a level which is sustainable so that management can signal confidence in the firm. Return residual cash by way of share buyback. Maricon approach. Maricon Associates, an international management consulting firm, has done pioneering work in the area of value-based management. Their approach has been comprehensively described in a book titled The Value Imperative. According to the Maricon approach, the following are the key steps in value-based management. Specify the financial determinants of value, understand the strategic drivers of value, formulate higher value strategies, develop superior organizational capabilities. The guiding principle of value creation is fairly straightforward. Companies create value when return on invested capital exceeds weighted average cost of capital and they grow. This was defined way back in 1890 by the economist Alfred Marshall. When this basic principle is ignored, consequences can be disastrous, as we saw with the rise and fall of conglomerates in 1970s in the US, with the collapse of Japanese economy in 1990 to 2010, with the global financial crisis of 2007-2008, with the value destruction by many infrastructure companies in India. Before we examine a comprehensive value metrics framework, let us recapitulate various measures of financial performance that we have learned in this program so far. Return on capital employed, also called as return on invested capital, return on investment, return on equity, return on sales, profit before depreciation, interest and tax, profit before interest and tax, profit after tax, net operating profit after tax, cash flow, free cash flow, economic value added, residual income, economic profit, earnings per share, dividend yields, total shareholder return, market capitalization, market value added, economic value added, residual income, and economic profit refer to the same phenomenon. We can look at a value matrix framework in terms of four levels: value drivers, financial determinants, intrinsic value, stock market performance. Value drivers are factors like market share, cost per unit, R&D projects, employee productivity. Financial determinants are return on invested capital, growth, cost of capital, invested capital. We have seen that these are factors which determine the value of discounted cash flow stream. To that, if you add the option value, you get the intrinsic value of the firm, which is also the market value of the firm in a well-ordered market. This has a bearing on stock market performance, which is measured in terms of total shareholder return and market value added. The value matrix framework can be represented in terms of a pictorial diagram which is visually very appealing. I have drawn this diagram from the work Valuation, Measuring and Managing the Value of Companies by McKinsey authors. Currently, this book is in its 7th edition, published in 2020. It is a seminal work which I strongly recommend to finance professionals. In this diagram, value drivers are shown at the right end. Value drivers are market share, cost per unit, value of R&D projects. Value drivers have a bearing on ROIC growth, economic profit or EVA, which in turn has a bearing on the DCF value of the firm, combined DCF value of the firm with real option value embedded in the operation of the firm. You get intrinsic value, which in turn has a bearing on stock market performance that is measured in terms of total shareholder return and market value added. This, as I said, is a seminal work, and I strongly recommend to those who want to explore this topic in greater detail. This is the 7th edition of the book, Valuation, Measuring and Managing the Value of Companies. Stock market performance. The most commonly used measures of stock market performance are total shareholder return or TSR, market value added MVA, and market to capital ratio MCR. TSR is defined as ending market value of equity plus distributions by way of dividends and share buyback during the year divided by beginning market value of equity plus additional equity raised during the year minus 1. Suppose the beginning market value of equity of a firm is 1000 crore rupees and the firm does not raise any additional equity during the year. Assume that the ending market value of equity is 1100 crore rupees and the firm distributes 30 crore by way of dividend. So in the numerator we have 1100 plus 30, which is 1130. In the denominator we have 1000. This divided by this gives 1.13. 1.13 minus 1 is 0.13. In percentage terms, it is 13%. The total shareholder return is expressed in percentage terms. In this case, it is 13%. Market value added is market capitalization minus capital employed. In this case, market capitalization at the end of the year is 1100 crore rupees. Assume that the capital employed in the firm as shown in the balance sheet is 600 crore rupees. Then market value added would be 1100 minus 600, which is 500 crore rupees. This represents a surplus generated by the company over and above the investment made by investors. Market to capital ratio or MCR is market capitalization divided by capital employed. In this case, market capitalization is 1100 crore rupees. Capital employed is 600 crore rupees. So MCR is 11 by 6. MCR is similar to profit to book ratio that we use in stock market discussion. Many financial analysts consider TSR to be the most important measure of value creation. Why? There are several reasons. One, TSR is comprehensive. TSR takes into account capital appreciation as well as dividend. Two, TSR is widely used by the investment community. It is a very popular measure with investment community. SEC in the US is also mandated that TSR should be calculated for all schemes. 3. TSR can be easily benchmarked. TSR is a rate of return measure which can be benchmarked against a relevant index. For example, the TSR of a company in India can be benchmarked against the TSR of Nifty for a certain period. 4. TSR is not biased by size. Unlike market value added, which is influenced by size, TSR is not influenced by size, it is not biased by size. 5. TSR is difficult to manipulate. The inputs that go into TSR are fairly objective. The most important inputs are market value of the company at the beginning and market value of the company at the end. These are objectively measurable from the marketplace, and the other input is dividend, which is also objectively defined. The stock market performance is like the expectations treadmill. The TSR exceeds the cost of equity if the company outperforms the expectations embedded in the company's share price. Here is an example. There are two companies, A and B. The current market price per share of A is 500. The current market price per share of B is 200. Expected EPS is 25 for A, 10 for B. These expectations are baked into the current market price. The actual EPS after a year turns out to be 24 for A and 12 for B. In the case of A, investors are disappointed. They realize that they had expected EPS to be 25, but the actual EPS turns out to be 24. So they believe that the future of the company is somewhat bleaker than what they had originally expected. So they revised the price downward to 480. This new price embeds the new expectation generated on the basis of the actual performance of the company vis-a-vis its projected performance. As a result, the TSR of company A is minus 4% if we assume that the company pays no dividend. Now look at company B. The current market price of 200 embeds an expected EPS of 10. The actual EPS turns out to be 12 after a year. So shareholders revise their expectation. They believe that the company has brighter future than what they had originally expected because it had outperformed the expectations. On the basis of this revised expectation, they bid the price up to 240. If we assume that the company pays no dividend, the TSR for company B works out to 20%. Even though the actual EPS of A is much higher than the actual EPS of B, TSR for A is negative, TSR for B is hugely positive, because in the case of A, the company has underperformed the expectations baked in the stock price. In the case of B, the company has outperformed the expectation baked in the stock price. The market expectation of future performance factored in the stock price is represented by the speed of the treadmill. If managers beat market expectation, they raise the expectation further. Put differently, they accelerate the treadmill and thereby deliver superior returns. But how long can any management outperform market expectation or accelerate the treadmill and produce superior returns? We can distinguish between corporate return and shareholder return. Corporate return is the rate of return the company earns on its real investment. Shareholder return is the rate of return shareholders earn on their investment in the company's shares. The corporate return exceeds cost of capital when the company invests in value creating opportunities. The shareholder rate of return exceeds cost of capital when the company outperforms the expectations embedded in the company's share price. A very useful work on value-based management is titled Value-Based Management, authored by John D. Martin and William Petty. Seminal work on performance management systems or organizational architecture has been done by James Brickley, Clifford Smith, and others. They have written a very insightful book titled Designing Organizations to Create Value. We will look at the highlights of this book. The performance management system or organization architecture of a firm is closely linked with the strategy of the firm. The strategy of the firm in turn is shaped by the business environment. Organizational architecture or performance management system has an important bearing on managerial incentives and actions which have a significant impact on shareholder value. So we can look at the firm in terms of a diagram like this. There is a business environment in which the firm operates. The three ingredients of the business environment are technology, markets, and regulation. This business environment has a very important bearing on strategy formulation. Strategy is formulated, as we have learned, at two levels: corporate level strategy and business unit strategy. Strategy has an important bearing on organizational architecture or performance management system. The performance management system or organizational architecture has three components: decision authority assignment, or what we call popularly delegation of authority; compensation system; performance measurement system. So the three important ingredients of organizational architecture are delegation of power, compensation system, and performance measurement system, incentives and actions, and shareholder value. Thus, the performance management system of a firm has three elements. One, delegation of power. Companies have a system of delegating powers to lower levels in various ways. We have seen that companies are organized in terms of responsibility centers. Two, performance measurement. Performance is measured using financial measures and non-financial measures. Three, system of rewards and penalties. Companies have a system of rewards and penalties. Companies give financial rewards as well as non-financial rewards for those who perform well, and they penalize non-performers in various ways. These three elements of performance management system may be likened to the three legs of a stool. If the legs are properly aligned, the stool would be in balance. Very few organizations get these legs perfectly aligned and are perfectly balanced in terms of their performance management system. Organizations are continually trying to improve their performance management system. One, delegation of powers. Firms are resorting to greater decentralization. This is a mega trend that we have seen globally in the last few decades. This is because firms have become large, complex, and geographically diverse, and the environment has become very volatile and dynamic. In such a situation, greater decentralization is an absolute necessity. Here are some examples of that phenomenon. Creation of profit centers at Tata Steel. When Dr. Irani was the MD of Tata Steel, he created a number of profit centers. He said, we had totally lost focus. We were spending more time trying to sell shrimp, coffee, spices, you name it. My achievements has been to solidly refocus on our core business. The management structure of Tata Steel has undergone drastic changes. We have introduced a profit center concept. The idea was to flatten the organization, remove fat, put decision-making authority down the line. I've told executives in charge of the profit centers that they are the MDs of their units. The central body works out the budgets and reviews performance, but the profit centers are independent in matters ranging from raw material purchase to marketing. Wipro's emphasis on empowerment. The head of each Wipro division or company is asked to prepare its own business plan for the year. The plan itself gives the target and the authority to the person. Empowerment at TCS. TCS has a distributed leadership model. It has empowered people. It has built a group of 40 to 50 leaders who have the willingness to scale up their operations. A word about exemplary leadership at TCS. TCS was set up as a division of Tata Sons under the chairmanship of Nani Palkiwala. He gave FC Kohli, its first CEO, complete freedom to set up the organization the way he wanted. FC Kohli laid foundations and processes for the organization. He was succeeded by Ram Dorai in 1996, who scaled up TCS for growth. He instituted decentralized decision-making to ensure flexibility. Ramdurai was succeeded by Chandrasekaran in 2009. Chandrasekaran pivoted TCS and effected a critical transformation from old era software services to new generation digital services. Gopinathan, who has taken charge in 2017, is continuing that tradition. Hindustan Unilever has one of the best performance management systems in the country. The key ingredients of its performance management system are decentralization, empowerment, differentiated pay for performance, learning and development plans, 360 degrees feedback. Higher, the Chinese white goods manufacturer reorganized its 80,000 person workforce into independent units. Each person was made responsible for managing his own profits and losses. After this move, its performance improved significantly and its market capitalization soared, tripling between 2011 and 2014. To performance measurement, companies are designing the corporate performance scorecard as a series of measure pairs which include leading indicators and lagging indicators which focus on internal concerns as well as external concerns which emphasize quantitative as well as qualitative criteria. Key metrics used at Walmart. Walmart uses a number of metrics to assess the company's performance: total sales, comparable store sales, operating income, diluted income per share from continuing operations, return on investment, free cash flow. Key result areas in Wipro. The following are the key result areas employed at Wipro. 1. Speed. The current cycle time is reduced by 20% each year. 2. Customer satisfaction. Each year, the percentage of customers who rate Wipro at 4 and 5 on a 5-point scale increases by 5 points. 3. Financial measures such as sales, sales growth and market share, return on equity, return on capital employed, PBT, PAT and cash flow. For norms of investment appraisal, 29%, ROE, 10 to 22%, return on capital employed. There are several weaknesses observed in performance measurement systems. 1. An excessive focus on operational and financial measures, most of which are tactical and historical. 2. A tendency to measure wrong or irrelevant things just because they are easy to measure. 3. A lack of proper alignment of measures either with each other or the strategy of the firm. 3. The system of rewards and penalties. The proportion of variable compensation has gone up in most of the organizations. There is a lot of controversy surrounding executive compensation. Designing executive compensation is a challenge. The compensation plan for managers consists of 3 elements: salary, benefits such as pension plan, health benefits, perks, incentive compensation such as bonus and employee stock option plans. Failure of executive compensation plans to promote value creation. Often executive compensation plans fail to promote value creation because of 3 shortcomings: linkage between size and pay, emphasis on short-term performance, reliance on accounting measures. As Rappaport says, the dysfunctional consequences introduced by the increased pay for increased size philosophy and the overemphasis on short-term results are exacerbated by the universal use of accounting measures for assessing both short and long-term performance. Stephen O'Brien, an international authority on executive compensation, has identified 4 basic objectives for a firm's compensation policy. 1. Alignment. The compensation policy must provide incentive for managers to take strategies and actions to maximize shareholder value. 2. Leverage. There should be adequate compensation to managers to work harder, take risks, and do unpleasant things meant to maximize shareholder value. 3. Retention. The total compensation must be sufficient to retain talented managers, particularly during bad times. 4. Shareholder cost. The cost of management compensation should be limited to a level where shareholder value is maximized. Alfred Rappaport, an international authority on shareholder value creation, offers these suggestions for incentive compensation. 1. Reward CEOs and other senior executives for delivering superior long-term returns. They must deliver superior returns over a period of 5 years or more. 2. Reward operating unit executives for adding superior multi-year value. 3. Reward middle managers and frontline employees for their performance and value drivers that they influence directly. 4. Require senior executives to have an equity stake in the company. Many organizations now require senior executives to have a continuing equity stake in the company, which is at least equal to 2 times or 3 times their annual compensation. This is a device to align the interest of managers more closely with the interest of shareholders. Given the importance of incentive compensation, extensive research has been done on incentives. The key findings of the extensive research are: 1. Individuals are more strongly motivated by the potential of rewards rather than the fear of punishment. 2. Individuals are highly motivated when they receive reports, feedback about their performance. 3. Motivation is weakest when the person perceives an incentive as being either unattainable or too easily attainable. 4. An incentive is less effective when the period between action and the report of it increases. 5. Incentive is strongest when managers participate actively along with superiors in the process of arriving budgeted targets. Research evidence on incentives. 30 years of research involving 128 experiments on motivation concluded that tangible rewards tend to substantially have a negative effect on intrinsic motivation. Federal Reserve Board commissioned 4 economists from MIT, CMU, and University of Chicago, and they reported in 2005 in 8 out of the 9 tasks we examined across 3 experiments, higher incentives led to worse performance. London School of Economics analyzed 50 studies of corporate reward schemes. We find that financial incentives can result in negative impact on overall performance. While performance-based pay is commonplace, it can be dysfunctional. A 2017 Harvard Business Review article argues that top executives should be paid a fixed pay and not a performance-based pay. There are 5 problems associated with performance-based pay. 1. Contingent pay works only for routine tasks. Manual task is non-routine and unstructured, and contingent pay is not suitable for such tasks. 2. Fixating on performance can weaken it. If managers are obsessed with certain performance targets, their performance may be weakened. 3. Extrinsic motivation crowds out intrinsic motivation. 4. Contingent pay too often results in fraud. People discover ways and means of gaming the system and also commit frauds. 5. Measuring performance is notoriously fraught. Barry Schwartz, an eminent psychologist, observed, "We need incentives. People have to make a living, but excessive reliance on incentives demoralizes people in 2 senses of that word. It causes people who engage in that activity to lose morale, and it causes the activity itself to lose morality." In practice, executive compensation is determined by a tight circle of directors, senior managers, and consultants. They rely on benchmarking. Benchmarking exercises merely reinforce the norm, with packages justified as needing to buy the best talent or meeting the demands of a competitive market. As John Kenneth Galbraith, the famous American economist, observed eloquently, the salary of the chief executive of the large corporation is not a market reward for achievement. It is frequently in the nature of a warm personal gesture by an individual to himself. According to Paul Krugman, a Nobel laureate in economics, the argument that greed is good for society is seriously flawed. As he says, a system that lavishly rewards executives for success tempts those executives who control much of the information available to outsiders to fabricate the appearance of success. Aggressive accounting, fictitious transactions that inflate sales, whatever it takes. Here are a few incentive and reward ideas for promoting fact-based performance culture. Celebrate wins, reward effort, not just results. Reward immediately. Don't create habits or expectations. Don't hardwire KPIs to compensation. Balance rewards of individual and corporate performance. Be creative with rewards and recognitions. In addition to organizational architecture, organizational culture matters. It matters a great deal. Corporate or organization culture refers to the psychology, attitudes, beliefs, and values of an organization. It is what the employees do when no one is looking. In Good to Great, Jim Collins has provided evidence that companies with strong, disciplined cultures have outperformed their peers. Nitin Noria, in his book Sustained Success, echoes a similar view. In his book A Business and Its Beliefs, Thomas Watson Jr., founder of IBM, ascribed the success of the company to culture and values rather than technology itself. Among other things, a company has a healthy culture if it accepts and appreciates diversity, it treats each employee fairly and respects his or her contribution to the company, it provides an equal opportunity for each employee to realize his or her full potential within the company, it instills pride and enthusiasm among employees for the organization, the company, it communicates effectively with all employees regarding policies and company issues. Its leaders display a strong sense of direction and purpose, and it invests in learning, training, and employee knowledge. Here is a glowing example of corporate culture. On 9/11, Meg Whitman, the CEO of eBay, was on a business trip to Japan. With phone lines out of order and a 14-hour time difference, she could not reach the company's headquarters in San Jose, California. The company's chief operating officer was also on a business trip to Florida. Several hours later, when Whitman could get through to the company by phone, she communicated three key priorities to her management team: verify the safety of every eBay employee, ensure the security of eBay's website, and organize an online charity auction to help the victims of the catastrophe. Whitman's team informed her that the three tasks were not only identified but also completed. Alan Rosling, a former executive director at Tata Sons, observed, "One of the great strengths of the Tata Group is its unique culture and approach to business. Other than professionalism, a pursuit of quality, fair dealing, and a commitment to the community, a significant strand of this culture has always been diversity, tolerance, and internationalism." Let us sum up our discussion. Corporate objective has been defined variously: shareholder wealth maximization, stakeholder theory, enlightened value maximization, shared value, and triple bottom line. There is a growing emphasis on creating long-term economic value in a legal, ethical, socially responsible, and environmentally sustainable manner. Several approaches have been suggested for value-based management. ALCAR approach, Stern Stewart approach, also called the EVA approach, Maracon approach, McKinsey approach, and BCG approach, and several others. EVA approach has gained greater popularity largely because of its simplicity. The value metrics framework helps us in understanding the drivers of value at various levels. There are three components of performance management system, also called as organizational architecture: assignment to decision rights, performance measurement, and system of reward and punishment. Determining executive compensation is a challenge. Organizational culture matters a great deal. Thank you.